Have you ever tried to figure out which company is actually healthier, a tiny startup or, say, a huge global corporation? Well, their final profit numbers can be super misleading. Today, we're going to zero in on one single metric that cuts through all that financial noise to reveal a company's true operational strength, and that metric is EBIT. I mean, think about it. On one hand, you've got a simple lemonade stand. Maybe it has a small loan from a parent. And on the other, you have this massive tech company with really complex debt and operations all over the world in different tax regions. How on earth do you compare their core business performance, their bottom line profit numbers? They can tell you two totally different and honestly pretty misleading stories.
And the answer, the key, is EBIT. That stands for earnings before interest and taxes. You should think of it as a company's raw, unfiltered operational profit. It tells you exactly how much money the business is making from its main activities, before you even think about how it's financed or what its tax bill looks like. It really does level the playing field.
Okay, so there are two main ways to get to this number. We're going to start with the first method, the top-down approach. And that means exactly what it sounds like. We're going to start right at the top of the income statement with the total sales and just work our way down. To see how this really works, let's use a simple, hypothetical business that is absolutely killing it in the lemonade game. We'll call them lemonade legends. So, how do we get from their total sales all the way down to EBITDA? It's a pretty clear path. First, you start with your total revenue. Then, you subtract the cost of goods sold. That's the direct costs, like the lemons and the sugar. What you have left is your gross profit. From there, you just subtract the operating expenses, things like marketing or rent for the stand, and boom, what's left over is your EBITDA. All right, let's put some actual numbers to this. So, Lemonade Legends brought in $2,000 in revenue. We subtract the $500 for lemons and cups, which leaves a gross profit of $1,500. Then, after we take out $300 for operating costs like their flyers and signs, we land on an EBITDA of $1,200. And there it is. That $1,200 figure, that represents the true earning power of the Lemonade Legends business itself, completely separate from any loans or taxes. It's the core profit they make from just selling really, really good lemonade.
But what if you're looking at a financial report and you can already see the final net income? You don't have to start all the way from the top. There's a shortcut. We can use the bottom-up approach.
A great way to think about this method is like you're unwrapping a present. The net income, the final profit number, that's the wrapped gift. But we want to peel off those layers of taxes and interest to see the valuable thing that's actually inside, the real operational profit.
The logic here is super simple. We're just doing everything in reverse. We start with that bottom line number, the net income, and then we just add back the two things we ignored before, the taxes the company paid and the interest it paid on its debts. And the result? It gets us right back to EBIT.
So let's try this with our tech company, Galactic Gadgets. Their financial statement shows a net income of $5,000. It also shows they paid $1,500 in taxes and $1,000 in interest on their loans. By just adding those two costs back to the net income, we get an EBIT of $7,500. So the operational profit for Galactic Gadgets, just from its core business of selling awesome tech, is $7,500. See? We've successfully unwrapped that net income to find the core earnings hidden inside.
Okay, so we've done the math, but why does this one number matter so much? Well, this is where EBIT becomes kind of a superhero metric for anyone who's analyzing a business. Just imagine this. Company A has a ton of debt, so its net income looks kind of small because of all those high interest payments. Meanwhile, Company B has low debt, so its net income looks fantastic. By using EBIT, we get to ignore those financing decisions and see which company is actually more profitable from its day-to-day operations. It reveals that true, underlying strength.
So when you boil it all down, EBITDA is so powerful because it isolates a company's core performance. It lets you make fair apples-to-apples comparisons by stripping away all the noise from different debt structures and tax rates. It just shows you the pure, unadulterated profitability of the main business. All right, so after all those numbers and calculations, what's the single most important idea to walk away with here? It really all comes down to this one simple point. This is the key. Financial statements are packed with information and a lot of potential distractions. Look, a company's debt structure and its tax rates are important, but they can totally hide how well the actual business is running. EBIT just clears away all that fog and shows you the engine itself.
So, Now you know how to look past interest and taxes to find a company's core profit. And that leads to a final, really important question. What other kinds of distractions, or maybe one-off items on a financial statement, might be hiding the true, repeatable performance of a business? That's definitely something to think about for next time.